beat the inflation and make it show that apart from continuously increasing the value of that particular portfolio, our wealth is also secured. We have also discussed the tenets of the portfolio construction. Apart from this, we have also discussed introduction to fundamental analysis, different types of portfolios, be active portfolio management or passive portfolio management, understanding market capitalization, portfolio construction approaches, and different terms and jargons of portfolio management. In today's session, we will discuss about market behavior, what is equity market, how it is going to function, journey of Sensex, understanding corrections and crashes, what are the various factors which can have effect on stock market fluctuations, or putting it otherwise, what are the various reasons for which stock markets there are movements in other stock markets, inferences of market behavior or mutual funds, emerging trends in investor behavior. Now, what is equity market? Equity market is a place where stocks and shares of companies are traded. In physical market, commodities, different types of items, be it stationery goods, be it grocery items, be it shoes or ready-made clothes or general clothes, these types of items are going to be sold and purchased. Whereas in equity market, that is a place where only stocks and shares of companies are traded. The equities that are traded in an equity market are either over the counter or at stock exchanges. Often called as stock market or share market, an equity market allows sellers and buyers to deal in equity or shares in same platform. First thing, first, it is important to begin with good understanding of what is equity market in Indian context. Equity market, often called as stock market or share market, is a place where shares of companies or entities are traded. The market allows sellers and buyers to deal in equity or shares in same platform. In global context, equities are traded either over the counter, as I have already discussed with you, or they can be traded in stock exchange. Now, how is stock market in India? Equities are mostly traded on stock exchange in India. In Indian stock market, equities are available for trading at National Stock Exchange and the Bombay Stock Exchange, and the latest entrant, Metropolitan Stock Exchange of India, that is MSC. Shares of stock market, listed companies are bought and sold. Equity shares trading is roughly in two forms: spot or cash market and futures market. These are the different types of equity markets in India. The spot market or cash market is a public financial market in which stocks are traded for immediate delivery. The future market is a place where the shares delivery is due at a later date. With the help of an equity trading account, a trustworthy broker like Sher Khan or any other stockbroker, and the online equity trading system, investors can utilize the Indian equity market. The question arises, what is growth in equity market? Shares or stocks traded in equity market belong to companies that show growth. Investors typically invest in growth stocks which belong to small companies showing potential for high growth rates. The growth stocks are those where investors are ready to make big bids in live equity market, be it in
Q
India or global equity market. Now, with the help of online equity trading, investors aim to accumulate growth stocks today so that they can sell them after incredible low prices. Now, question arises, is there any pros and cons of trading in equity market? Yes. So what are those? Let us discuss first one, the pros of equity market. Great wealth creation. The biggest benefit of equity market is the opportunity to make huge profit. Many investors have experienced big returns that can never be given by any other financial investment. Enter and exit easily. In case of equity market, you can easily enter and exit a stock. This should be compared to when you want to sell a house, when where you cannot sell it on your own will always. Low taxes. When an equity is sold for profit after holding for more than 1 year, the profit attracts only 10% tax. Whereas in case of fixed deposits, the tax rate is as per the individual tax rate, that is, it can go up to 30% depending upon in which tax slab the person is or the individual is in. Cons of equity market. Lack of understanding can be costly. This is very important. Now, it is maybe possible that due to peer pressure or environmental surroundings, that is the news and all that stuff, we although a particular person is not having particular knowledge of stock market, still he is going to make investment in stock market. Now, there is a saying also, popular saying also, that half the knowledge is always dangerous. If you do not properly do research or invest in bad stocks, your chances of making losses are high in a equity market live type situation. So we are required to be careful and need to invest our hard-earned money in stocks wisely, so that in case of any losses, we are not in a position to be in trouble. Equity market can be volatile. It is very much true. Now, due to various environmental factors, external factors, it is possible that equity markets are volatile. They do not always remain same. They do not even on a decline continuously, and they do not even at a growth stage continuously. Equity investment return does not move in a straight line. There are upswings and downswings in live equity market. There is a risk of capital erosion as well. Equity share trading involves a chance of capital erosion. So we are required to be very much careful. Fluctuations in stock market. What are the various factors which affect stock market fluctuations? Fluctuations and volatility are the inherent behavior of stock market. Prices of stocks are dynamic, which is essential. Static prices does not make a difference. Perceptions by participants are built around the volatility of stock market. Market rising and falling and again rising is common behavior. Understanding and managing emotions are the key points. So now the question arises, why do prices fluctuate? Besides various other important factors, basically there are three, that is fundamental attributes, demand and supply attributes, and the sentiments of individual investor. Stock prices are determined in marketplace where seller supply meets buyer demand. But have you ever wondered about what drives the stock market, that is, what factors affect a stock price. Unfortunately, there is no clean equation that tells us exactly how the price of stock will behave. That said, we do not know a few things about the forces that move a stock up or down. These forces fall into three categories, that is fundamental factors, technical factors and market sentiments. As far as fundamental factors are concerned, these are linked to specifics of the company such as business, brand, financial statements and management. Demand and supply attributes are linked to what people perceive about the company's performance. Sentimental attributes is linked to factors such as bad news about the company, outcome of election result, war and similar crises, geopolitical uncertainties, economy not doing well, and so on. A company reporting good financial performance, a solid acquisition, increase in market share may lead to high demand and positive sentiments leading to increase in share price. For example, recently there is a news that Tata Motors are going have received an order from China also, right? Now, due to that particular reason, the stock prices of Tata Motors were up. Opposite is when a company reports bad performance, loses market share, regulator has imposed restrictions, as we have seen on Paytm, RBI has imposed certain restrictions, some scam within the company, and so on, leading to selling pressure and negative sentiments, leading to fall in prices. As we have seen the fall in prices of Paytm as well. Fluctuations may have many reasons. Now, as far as fundamental factors are concerned, it is an in an efficient market, stock prices would be determined primarily by fundamentals, which at the basic level refer to a combination of two things: an earning base, such as earning per share, a valuation multiple, such as PE ratio. An owner of a common stock has a claim on earnings, and earnings per share is the owner's return on their investment. When you buy a stock, you are purchasing a proportional share of entire future system of earning. That is the reason for the valuation multiple. It is the price you are willing to pay for future stream of earnings. Part of these earnings may be distributed as dividends, while remainder will be retained by the company on your behalf for future growth and reinvestment. We can think of future earning stream as a function of both current level of earnings and expected growth in this earning base. The valuation multiple or the stock price or some multiple of PEs is a way of representing the discounted present value of anticipated future earning stream. The earning base, although we are using EPS, an accounting measure, still there are other measures of earning power. Many people argue that cash flow based measures are superior. The way earning power is measured may also depend on the type of company being analyzed. Many industries have their own tailored metrics. Real estate investment trusts, for example, use a special measure of earning power called fund from operations. Relatively mature companies are often measured by dividend per share, which represent what the shareholder actually receives, and that is true as well. The quality of the shares can be judged by the value the shareholder is going to receive annually or quarterly in his account in terms of dividend. The valuation multiple. It expresses the expectations about the future. It is a fundamentally based on discounted present value of future earning stream. So, two key factors are the expected growth in earnings base and the discounted rate, which is used to calculate the present value of future stream of earnings. A higher growth rate will earn the stock a higher multiple, but a higher discount rate will earn a lower multiple. So what determines the discount rate? First, it is a combination function of perceived risk. That is, as per investor, what is the percentage or the proportion of risk which he might be having after purchasing that particular stock. A riskier stock earns higher discount rate, which in turn earns a lower multiple. Secondly, it is a function of inflation.
अच्छा
Higher inflation earns a
है भालू
higher discount rate, which earns a lower multiple.
की
The level of the earnings base
चल
will also
चल
decide the risk level. The expected growth in the earning base. So technical factors. Things should be easier if only fundamental factors set stock prices. Technical factors are the mix of external conditions that alter the supply and demand for a company's stock. Some of these indirectly affect the fundamentals. For example, economic growth indirectly contributes to earnings growth. Fluctuations may have many reasons. What one participant reads a situation of stock may be different from another participant. It may depend upon the risk appetite of the individual or even the personality factor, the mindset of that individual as well. The market reacts or responds to what maximum people are thinking. More people are bullish or bearish or not having any view at all, leading to directionless market trend. Market moves on trends largely. Now, if we discuss about inflation, inflation is a huge driver from of a technical perspective. Historically, low inflation has had a strong inverse correlation with valuations. Deflation, on the other hand, is generally bad for stocks because it signifies a loss in pricing power for companies. Economic strength of market and peers. Company stocks tend to track with the market and with their sector or industry peers. Some prominent investment firms argue that the combinations of overall market and sector movements as opposed to a company's individual performance determines a majority of stock movement. For example, a suddenly negative outlook for one retail stock often hurts other retail stock as well. Policies and regulations. A favorable shift in government policies will drive the markets up. An unfavorable one will reduce confidence level of investors and it may cause a downward shift in the market. Changes in international trade agreements and their associated tariffs can impact stock purchasing power of investors. This will impact the competitiveness of industry and disrupt the supply of international resources. The government can also impact the overall liquidity of economy by altering fiscal policy. A, contradic- a contradictory fiscal policy will lower the level of liquidity, driving investor confidence down and making the markets less attractive for investment. Banking system. The central bank has great influence over the level of engagement in financial markets. An upward movement in interest rates will increase the cost of borrowings and make it less lucrative for businesses to increase investment. It will also lead to a fall in consumer spending in economy. Likewise, a fall in interest rates will cause investments to rise and consequently the financial markets will flourish. RBI can directly impact these movements through changes in monetary policy. A relaxation in monetary policy will cause an injection of currency in economy, increasing liquidity and also stock prices. Institutional investors. Both foreign institutional investors and DIIs, that is domestic institutional investors, have crucial role in deciding the fate of financial markets. Any entry or exit decision by these two types of investors causes a significant impact on the equity value because they are going to purchase in bulk. These investors play a vital role in price discovery process in the market. They run through research and analysis on securities to drive the markets toward accurate price levels. Due to the high volume of their trades, their involvements help keep the market at an optimum level. These investors also hold the power to stabilize distressed market conditions. Due to the high volume of their trades, they have the potential to execute transactions that control price fluctuations during volatility and ensure stability. International relations and geopolitical volatility. Now, since we live in interconnected world where any movement in economic conditions of one nation will cause a domino effect on other economies as well in terms of trade or investment flows. A downfall in one economy can have a scaled impact that goes as per the global level. An impact on relations between different nations can also cause political instability and trade tensions. It leads to disruptions in supply chains, moving consumer spending, and driving investor confidence to fall. Forex fluctuations. Now, fluctuations in the foreign exchange rates will also have an impact on the stock movements, whether upwards or downwards. The valuation of a currency will have significant impact on revenues of multinational corporations. This will directly impact the level of foreign direct investment in economy, especially for corporate headquartered or having a significant proportion in foreign nation. This kind of movement will make the nation less appealing to foreign investors, consequently causing a slowdown in financial markets. Substitutes. Companies compete for investment dollars with other asset classes on a global stage. These include corporate bonds, government
A.
bonds, commodities, real
Has.
estate, and foreign equities. The relationship between demand for US equities and their substitutes is hard to figure, but it plays an important role. Incidental transactions. Incidental transactions are purchases or sales of a stock that are motivated by something other than belief in intrinsic value of stock. These transactions include executive insider transactions, which are often pre-scheduled or driven by portfolio objectives. Another example is an institution buying or shorting a stock to hedge some other investment. Although these transactions may not represent official votes cast for the against the stock, they do impact supply and demand and therefore can move the price. Demographics. Some important research has been done about demographics of investors. Much of it concerns these two dynamics. Middle-aged investors, peak earners who tend to invest in stock market. Older investors who tend to pull out of the market in order to meet the demands of retirement. The hypothesis is that the greater the proportion of middle-aged investors among investing population, greater is the demand for equities and higher the valuation multiples. Next is trends. Often a stock simply moves according to a short-term trend. On the one hand, a stock that is moving up can gather momentum as success breeds success and popularity bias the stocks higher. On the other hand, a stock sometimes behaves the opposite way in trend and does what is called reverting to the mean. Unfortunately, because trends cut both ways and are more obvious, knowing that stocks are trendy does not help us predict the future. Liquidity. It is one important and sometimes underappreciated factor. It refers to how much interest from investors a specific stock attracts. Walmart's stock, for example, is highly liquid and thus highly responsive to material news. The average small cap company is less. Trading volume is not only a proxy for liquidity, but it also a function of corporate communication. Large cap stocks have high liquidity and they are well followed and heavily transacted. Many small cap stocks suffer from an almost permanent liquidity discount because they simply are not investors' radar screens. Natural calamities bring the highest level of uncertainty in market. Events like earthquakes, tsunamis, and hurricanes can impact the level of production and supply chain within the economy. This will drive down the overall growth, level of spending, and liquidity. Nations more prone to such disturbances will have more risk-averse people who will prefer holding cash for such situation and be less involved in stock market. As an investor, we must understand that the stock markets are influenced by multitude of other variables as well. This makes it is a complex and dynamic system, continually shaped by variety of forces. News. While it is hard to quantify the impact of news or unexpected developments inside a company, industry, or global economy, we cannot argue that it does influence investor sentiment. The political situation, negotiations between countries or companies, product breakthroughs, mergers and acquisitions, and other unforeseen events can impact the stocks and stock market. Since securities trading happens across the world and markets and economies are interconnected, news in one country can have an impact on investors in almost another country instantly. News related to a specific company, such as release of a company's earnings report, can also influence the price of stocks. So in general, strong earnings result in stock price moving up and vice versa. But some companies that are not making that much money still have a rocketing stock price. This rising price reflects investors' expectations that the company will be profitable in the near future. However, regardless of the stock price, there are no guarantee that a company will fulfill investors' current expectations of becoming a high earning company in future. Market sentiments. These refer to the psychology of market participants individually and collectively. This is perhaps the most vexing category. Market sentiment is often subjective, biased, and obstinate. You can make a solid judgment about a stock's future growth prospects, and future may even confirm your projections. But in the meantime, the market may myopically dwell on a single piece of news that keeps the stocks artificially high or low. Market sentiments is being explored by the relatively new field of behavioral finance. It starts with the assumption that markets are apparently not efficient much of the time, and this inefficiency can be explained by
How the
psychology
theory
and
of
other social
probability
science discipline.
in market? How the theory of probability work in stock market? How the theory of probability work in stock?
So let us understand market versus index. The performance of market is measured by the performance of an index or indices. The collective performance of underlying stocks of the index reflects the trend or direction of market. Based on the index performance, the trends are defined such as bullish, bearish, flat, and volatile. Now, investors or market participants like the market to be rising always. Making a profit or being in profit is the only motive. Any deviation from their expectation may lead to negative sentiments, leading to selling pressure. The performance of market largely reflects the investor or participant's perception. Let us discuss about market or index performance. Over the years, that is since 1979, the Sensex has grown up from 100 to 67,000 nowadays between 1979 and 2024. The annual compounded return has been about 18%. From very low participation to very high participation by traders, investors, and other stakeholders, market has grown from strength to strength. The first 1000 points took almost 11 years. Then 10,000 points happened during Feb 2006. That is 27 years later. And in less than 2 years, the market jumped to 20,000 points in year 2007, and it took less than 2 years time. April 2017 saw the index at 30,000, June 19 at 40,000, Feb 21 touched 50,000, September 2021 crossed 60,000. It is not a bed of roses. The market has experienced its share of good, bad, and ugly events throughout the journey. From Shrimati Indira Gandhi assassination to Gulf War to Rajiv Gandhi assassination to the era of globalization and privatization to 9/11, changes in government, crude oil touching $147 per barrel, subprime crisis, scams in India, political instability and stability, India shining among the world, COVID, Russia-Ukraine war, and so on. The 2020 year market performance. You can just check from the 1st January 2020 to 31st December 2020. The market was bull, bear, and again bull. 2022 market recovery, that is from post COVID time. The market recovered from 30,000 to approx 60,000. Market crash and recovery 1. From 41,000 levels in the month of January 2020 to 25,000 levels in March 2020. The market crashed by 39% within a short time. But the full recovery of market happened soon. By November 2020, the market recovered back to 40,000 level. By the end of December 2020, the market has zoomed past 47,000. 2007 year market performance. That was the one of the best market performance in the shortest time. We can just have a look on the graph. 2008-9 year market performance. Steep fall in the market, 15 months of bear market. Sensex crash from 21,000 points to 8,000 level. Recovery phase. Sensex recovery from bear to bull from 8,000 points to 20,000 level. Market crash and recovery 2. From the best bull phase witnessed in 2007 to the worst bearish phase witnessed in 2008-9. The highest fall ever, 61% fall in index. All hopes had diminished, despondency had set in by March 2009. But slowly the market recovered back to 20,000 levels. The phase of bull, bear, and bull. Now let us discuss the history of market crashes. In 1992, we have witnessed Harshad Mehta scam. In 2000-2001, dot-com bubble. 2008-9, subprime crisis. 2020, we have witnessed COVID-19. In 2015, we have witnessed yuan devaluation and Brexit. In 2016, we have seen demonetization. Intensity of a crash. Historically, Index falling over and above 30% on a continuous basis has led to a crash. About market crashes, the markets manifests bubbles over time. Such bubbles are due to experience, overconfidence, high liquidity, lack of fundamentals but still buying, perpetrated by individuals or institutions. Bubbles grow bigger, leading to bigger crashes. Difficult to predict or avoid such crashes or bubble bursts. Now we can just have a look on the corrections and crashes from the year 2000, from the year 1992 to 1993. Crash 1, correction 1 is 94-96. Crash 2 is year 2000 to 2001. Correction 2, 2004. Correction 3 is 2006. Crash 3 is 8 to 9. Correction 4, 2010-11. Correction 5, 15-16. Correction 6, 18. Correction 4, 20 and 7, 21-22. Now let us understand what are the corrections. Corrections are different from crashes. Usually corrections seek quick recovery. Index falling daily by few points can still be a correction. Corrections are smaller than crashes. Index falling below 1% in a trading day can be called as a correction. You can just have a look on the tables. Now let us discuss market crashes and equity mutual funds. Mutual funds are derived products. The NAV performance directly reflects the market performance. Equity mutual funds too display high volatility as measured through its volatility. NAV rise and fall are linked to rise and fall in market or in index. We can just see NAVs of a flexi cap fund from year 1995 to 1996. NAV was in the beginning 9.29 and in 1996 it is just half, that is 5.15. In year 2000 NAVs of a flexi cap fund was 23.93 and in 2001 and it was 15.1. In 2007 213 and 2009 only 93. In 2020 676 or in May 20 478. The NAVs on three different dates can be observed. The crash in market clearly reflects in the performance of the NAV. From 9.29 on 10th January 1995 to 5.15 on 10th December 1996. The drop in NAV is almost 50% in 2 years. Such crashes in NAVs can be witnessed on other occasions as well. After every crash, markets have recovered, which is the simple rule of market. NAVs too have sharply recovered post market crashes. The time taken for NAV to recover is similar to the time taken for markets to recover. Some recoveries have taken 2 years, some 4 years, but they have recovered ultimately. NAVs of mutual funds cannot remain static. They are dynamic. NAVs changes every day. NAV up and up is where the profits would come from. Rupee cost averaging works with such volatility, offering handsome gains over longer period of investing. Now let us discuss emerging trends in investor behavior. It is common for market participants to show exuberance in bull markets and despondency in bear market. Reactions are common than responses. Market performance or NAV performance reflects participants' reaction, but investor behavior is changing in the recent times. The first crash in 1992 made investors to panic. Second crash in 2000 made investors to again panic. In third crash 2008-9 brought participants on their knees because there was 61% crash. But the crash in 2020 surprised many. Despite the world's worst economic situation, market recovered quickly and smartly in shorter period of time. Increased financial awareness, not panicking, seeing fall as an opportunity to invest are all new changes witnessed among the current creed of participants. The number of participants in these markets have increased significantly, increasing the
One
market
second, Dow
width
Jones.
and breadth.
One second, Dow
Fresh
Jones.
money flow during market downtrends leading to
One
market
second, Dow Jones.
holding
How it's
up.
affecting in the stock market?
Nobody has been able to predict the future of market. People wait or follow trends but fail to precisely predict the next movement. Peaks and bottoms of markets are just plain discussions. Before every crash, there is exuberance, and after every crash, there is despondency, and then there is again a rise. Staying invested, not panicking during market crash, keep waiting for good opportunities to enter with fresh buying, holding on to good investments until recovery are all simple response to market crashes. Crashes cannot be avoided in future too, but our response matter the most. Every dark cloud has a silver lining. In today's session, we have discussed about market behavior, journey of Sensex, understanding corrections and crashes, inferences of market behavior on mutual funds, factors affecting stock market fluctuations, and emerging trends in investor behavior. So thank you guys. In case of any query, you are most welcome to ask.
Excuse me, sir.
Yes.
Sir, how to identify the market trend as you discussed, like bullish and bearish? So, how we can identify the market trend for investment?
Actually, it will also depend upon how much we have gained the knowledge of financial market. But once suppose the market is going up, so that is a condition of bullish market and vice versa,
Okay.
right?
Okay. And sir, one more thing, like other stock market, like Dow Jones and Nasdaq, how these are affecting Indian stock market?
Because once, as we have already discussed, that in all the financial markets, be it in India or in the US market, all are interconnected, right? Now suppose a particular incidence is going to take place in US companies, that is also going to have impact on the domestic market of India as well, because there are so many foreign institutional investors who are also going to invest in Indian companies, and similarly Indian investors are also invested in the stocks of the US companies and so on, right? So any we can say any external environmental factor or any change in the external environment is definitely going to have impact on overall financial environment, be it domestic or it global, right?
Okay, sir. Thank you.
Right. Yes, any other doubt or query? Yes guys, you can leave the class. Take care. Bye bye.
भाई हो ही नहीं सकता, थोड़ा तो इम्पैक्ट आया ही होगा उसको बंदे को, कभी नहीं हो सकता, बस जड़ा घबरा रहा है उसकी।
चेहरा तो पता होगा ना मुझे उससे बड़ा मजा आता है, इतना मजा कौन नहीं दे सकता। तो कुछ पता हो तुमको बड़ी अच्छी से फिर पूछो भाई, मजा ही मजा। हम तो व्यस्त दिन हमारा पिता धोने है, बेटा बोलो ठंडा होने दो यार, गजब बात है।